Hello, and welcome to another episode of Desi Fire podcast. For those of you who might be joining us for the first time, we talk about financial independence and early retirement on this channel. And today, to help us with all that, we have Rahul Singh with us. He's a senior portfolio manager at LIC Mutual Fund. He primarily looks after the fixed income space. He has done his MBA from IIM Ahmedabad, which was around 20 years ago now, and most of his career has been spent in the financial management industry one way or the other. So that being said, welcome Rahul, welcome to the show.
Thank you, Ravi, for having me on the show. Thank you very much.
So the first thing that I want to ask you, this clarity that, I was going through your LinkedIn profile, and whether it was a trader, even when you were doing that, that was bond trading, you managed a lot of fixed income funds on the way up here. So did you know that when you were going in college that, okay, this is the space that I would want to get into? Or that was something that you decided after an MBA and maybe after a couple of jobs and stuff?
Actually, at that point of time, frankly, no student would, understand the complexities of financial markets. So what drives every student is, where you get the best placement. That was I think, the only criteria. But yeah, having said that, I think 2 years in IIM Ahmedabad, talking to a lot of my seniors, they figured out, if you want to earn money, earn well, it's better to be in the financial world. One thing led to another. I did my internships with a couple of foreign banks, and then joined ING. And from ING, yeah, one thing led to another. So today I'm here.
Fair. So the point what happens is because, we are more or less the same age. So I know that you passed out in 2008.
Yes, actually joined in MBA in 2006, and that was the bull period. Globally everywhere, the financial market was doing so well. People were earning good money. In fact, for our summers, it was a bumper placement. Kind of placement people got, the kind of locations they wanted. If you wanted the New York location, you would get that. So that kind of things we had seen, and suddenly come 2008, and we heard city filing for Chapter 11. We didn't know what Chapter 11 was until then. And then we figured out, yeah, there's some issue. But, everyone kept saying, okay, it's a small issue, and these banks are too big to fail, and, it could be a minor hiccup and all. But then we realized that something is missing, because when you started hearing news about, some smaller banks going bankrupt, and then Merrill got sold to Bank of America, and finally Citi had to be saved. Then we figured out, yeah, that is a big problem, and people getting laid off and all was something that is stay with me. Getting to see that, in the first year of your career was very, very different. So that was, yeah, it was quite amazing, and I think I was lucky enough not to get laid off. I saw so many people getting laid off. Half the office got laid off in the matter of 1 week. So it was very scary at that point in time, and very surprising also. Never expected this to happen after what I saw in 2006 and 7.
But one of the way central banks have essentially tried to handle these crises from various points of time, even COVID, for example, has been printing more and more and more money. Now, as you keep doing that, eventually the excesses of the system have to come at the forefront. And we haven't really had a crisis, I believe, after 2008, because even the 2021 was hardly anything. We are not really in a great position globally. I'm not talking about India, but in terms of global liquidity. So in your opinion, do you think that there is a crisis somewhere on the horizon in the next 6 months, year, or something like that? Essentially, the central banking driven crisis, if I can call it that. Do you see something of that sort happening in the next year or so?
You spoke about the financial crisis of 2008 and COVID. Of course, both were crises, and both the places the central banks had to intervene. I believe that the 2008 crisis was still manageable. First, because, it was something which was related to institutions and bigger corporates. And plus, most of the central banks had some kind of experience of managing crisis, from the 2000 .com crisis or crisis before that. So there, it was comparatively easier as compared to COVID, because they knew that the system had to be saved by infusing money. And then most of the central banks have those, tools available to claw back that kind of money, and which we saw in 2012-13. I think the biggest crisis that the central banks faced was what happened in COVID. Because COVID is something very different and unique, but in the last 50, 60 years, we've not seen a crisis happening because of an epidemic. And the biggest difference between a COVID and let's say a financial crisis was that financial crisis was limited to institutions, whereas COVID actually hit the last man standing on the ground. And that's why I think the central banks had to intervene in a big way and give out money to the last man standing. And that's what I think that the problem that you're facing today is because of that. Because what happens is that, when you give money to institutions to help them out, to bail them out, you have the tools to plow it back. But when it comes to the last man standing and you give out money to, pass out that particular phase, it creates a catastrophic multiplier effect. And that's why you see that even after 5 years, COVID, you see inflation is still there everywhere across the globe. Because, no one would expect, not even central banks would expect that what kind of impact it would have on inflation, going ahead. Because everyone who was there on the road, had to be bailed out, had to be given some kind of, lifeline to, because, when financial crisis happened, a normal vendor selling stuff on the road will not be impacted. For them, maybe slight business would come down. But when COVID happened, it would directly affect his livelihood. So those guys were actually giving out benefits and money so that they come out of this particular phase. And that's where the multiplier effect happened, and that's why you see the kind of inflation that we have seen across the globe. US is still struggling. I think that way Indian RBI had done very good job. I think they did come out with a lot of measures, but they ensured that it doesn't go out of control, which happened in the case of, let's say, a US or probably some European countries. And that's why they are still facing this problem of inflation. So I will not blame central bank.
I'm not blaming them at all, but I don't even know enough to understand what all they have done. So forget the blaming part of it. What I'm concerned about is whenever there are excesses in the system, it very often, if not always, leads to some sort of a recession. Considering that the Fed has cut rates, A, what do you think is the likelihood of something like that happening in India in the near future? And B, just for our viewers, if you can explain what is the impact of these rate cuts on debt mutual funds?
Suppose you invest 100 rupees, let's say you give it up for a FD to a bank. They promise to pay you certain interest rate every month. But in case of financial markets, the debt instruments that are available, the moment they are issued, they start getting traded. So the interest is fixed, but when it starts getting traded, at that point of time, there are different rates at which people will buy and sell that instrument. And the price of the bond, they are inversely related. When interest rates goes up, your price of the particular instrument comes down, and whenever the interest rate comes down, the price of the particular instrument goes up. So if rate cuts happen, yes, it's going to be a positive mark to market that would be there on your instrument. And if there's no rate cut or if there's a rate hike, let's say, then in that case it have a negative mark to market. In terms of our views with respect to rate cut, yes, rate cut should happen. Till last year or even last 2 years, I think the biggest problem for any central bank was inflation. But right now, I think growth takes a precedent in terms of the kind of numbers that every economy is throwing up. In fact, our economy, last 2-3 numbers, our GDP numbers have been on the downside. I think even RBI would take cognizance of the fact that our numbers have been poor, and with inflation more or less controlled, I think the focus of both government and the MPC has to be growth. And if that happens, there should be relaxation in rates. Even if there's no rate cut, I think there'll be more relaxation in terms of the liquidity, the kind of regulation that has come for banking system in last 1 year, which has made it difficult for them in terms of their credit growth. So those things should be relaxed enough. If that happens, then rates are going to come down.
Let's assume that this view turns out to be right. What debt funds should I buy?
If rates are going to come down, what makes sense is to buy the longer duration funds as long as possible. But, I think it also involves 3 basic principles that I always feel is important whenever you're taking an investment decision. First, it is your objective of investing that money. So that needs to be clear. Secondly, your risk appetite. Let's say you make an investment, within 2 months you find there's a war somewhere in the world and your market tanks. So can you take that kind of volatility in your portfolio? Not of course investment horizon. Now, if you make an investment, you must be having a goal and a horizon for that. Let's say if you want to buy a house in 10 years, you want to have a buffer for your medical contingency. That is an ongoing thing.
Can you give me some idea? Because I've seen these, there is something called the maturity, which is there when you're looking at a fund, and there is something which is called the duration, which is mentioned. And then the third part, which is typically mentioned, is the yield or the Y2M, which exists. Right. So when I'm talking about long term, especially if I'm planning to play this rate cut cycle view, whatever, should I be looking at higher modified duration, or should I be looking at, longer maturity? And what would be good values for them? I mean, to play this, what are some good numbers? I don't really know maturity of 5 years is good or 15 is good. So can you just give me some idea about this?
So obviously, higher maturity would mean higher modified duration. But yes, when I say long-term fund, it means higher modified duration. Higher the better. Of course, if you're playing on a rate cut scenario and you feel that wherever the rates are today and it's going to come down, let's say at 30 basis or 40 basis, the higher the duration will give you maximum benefit. The rate cut would not happen in every policy, right? It may happen now. It could be there could be a break of, let's say, 6 months or 1 year, and then one more happens. But during that time, I think your carry also plays a role. So a corporate bond would give you a higher carry as compared to a normal GSEC fund. So it's an individual call. What kind of risk appetite, I said, what kind of risk appetite you are willing to take. And as far rate cut is concerned, rate cut takes over a period of time. Not even if tomorrow RBI goes for a cut, there could be more cuts coming, but that may not happen immediately in next 2-3 months or 4 months. It may happen after 6 months or 1 year. So you have to stay invested. So my sense is at this point in time, one needs to take a 1 to 2 year call and stay invested in a long duration fund, and then probably take a call whether to stay invested or come out of it. It again depends on a lot of other factors and how global economics is shaping up. But as of now, take a 1 to 2 year call and stay invested in long duration fund. That makes more sense.
Since we talk about financial independence and early retirement, most of our viewers are people who are on that path. So let's assume that there is a 45-year-old early retiree who spends 20 lakhs a year, which is coming from his portfolio. He plans to keep 60 lakhs for this purpose. So essentially, 3 years of expenses, he will keep on taking out from this XYZ fund. The other 40 lakhs that he has, I've kept it as 1 crore so that 60-40 percentages are a little bit easier to calculate. So the other 40 lakhs that he has is essentially for the money that he wants to keep in debt, which he'll probably deploy in the equity markets in case there is a dip. Let's assume that he has more than enough equity, he has more than enough emergency funds, etc. So we are talking essentially about goals here. So one goal is cash for expenses for 3 years. And the other goal is, you don't know when you need that money, that you can need that money 1 month from now, and you can need that money 1.5, 2 years from now. So which category of funds should be looked at?
I think you need to segregate in a kind of a low duration fund and a long duration fund, probably a 50-50 mix. A long duration fund would obviously give him, in this current scenario, would give him a huge mark-to-market capital gain, assuming rate cuts happen in next 1.5 years. As far as low duration is concerned, I'm sensing that at least he would need money for a month. If he doesn't need money for a month, in that case, a low duration also would give him a kind of good capital gains. Not as high as a long duration fund, but yes, it will give him a good capital gain in next 1 month's time. And then whenever he needs the money, he can withdraw from there. But yeah, if he doesn't need the money urgently, then low duration would make more sense as compared to a liquid fund. So 50%, I would say he can keep it a low duration category or a money market category. And rest 50% he can keep it in a long duration fund. In the current scenario, when there's a rate cut probability is higher, 1 year down the line or 1.5 year down the line, probably the strategy could change depending on where the market is. But at this current juncture, I think
at this point of time, yes, absolutely.
that makes more sense.
We are recording this video on 6th of February 2025. I don't know when you guys are watching it, because it's quite possible by the time this video goes out, maybe the RBI has done some announcement that there is a rate cut that has already happened. So I just wanted to put the date out. The other kind of question which I got from one of the users is that we often talk about that, we should always maintain some sort of asset allocation, etc. And a hypothetical scenario which is often suggested, especially for early retirees and even for traditional retirees, is a 60-40 asset allocation sort of a ratio, that you put 60% of your money in equity or high growth assets, and you put 40% of your money in debt funds or debt-based assets or FD, PPF, whatever the fixed income one. Let's stick to just mutual funds. If I have to suggest one fund for equity, I would probably suggest an index fund that, get a Nifty 50 or a Nifty 500, or if you are in the US, maybe an S&P 500. That becomes a fairly good enough choice, and you stay in that forever by the time you die. And whenever you have to rebalance, just buy more of this. But very rarely do I see someone talk about that, okay, for the other debt part, can you give me what sort of fund should I be buying to keep it for that other part? Because this money is also going to stay sort of forever in nature. Amounts would change. Sometimes money will move from equity to debt or debt to equity. But this is going to be a forever fund, so to say.
So I think if it's a forever money, I believe a good short-term debt fund or medium-term debt fund would be an ideal opportunity for the person, because, first, it doesn't go in the typical high category fund, because that fund makes more sense when you're expecting a rate cut. But in normal times, if let's say the rate cycle changes, that fund would give you a lot of volatility as compared to a medium-term or a short-term kind of fund, because those funds are always in flavor. They typically range in that 1 to 3 or 4 year maturity bucket. Not only it takes care of your any opportunity that comes in from the form of mark-to-market gains, but also they give you a good accrual, from accrual perspective also. So these kind of fund, if you want to keep it, just always keep in these kind of funds, which is in the medium range of duration, gives you good accrual. And, as and when you require those money, I think those funds are the ones that will give you the maximum returns, over a period of 5, 6 years, 8 years. So those are the funds that I think will be the best bet for anyone investing money.
I have seen some advertisements and trailers and some people talking about an all seasons fund sort of a thing, an all seasons bond fund, for example, where you give the money to the fund manager and let him decide, boss, you want to keep there might be points of time when you want to keep a very high duration. There might be point of time when you want to keep a very low duration. Because even when I'm buying this short term or medium term, I am taking the decision for that 1 to 4 year period.
Exactly. So there are funds like that, which is a dynamic asset allocation fund, where there's no restriction on the kind of duration the fund manager wants to maintain. He can maintain as low as a 3 months or a 2 months, and he can maintain as long as a high tenure. Those funds also make quite a sense in terms of for investors who want to just stay invested and not use their brain. I think the problem with those kind of funds is that, debt market in technically is not a very liquid kind of market as of now in India. It is still gradually picking up pace, but yes, it is still not that kind of liquidity. So what happens is that when you invest in such kind of funds, although as investors you get liquidity because the fund house has to provide you liquidity, but from a fund management perspective, those funds at times get stuck in a liquidity kind of scenario where certain papers, which are long-term papers, if rate cycle is over and you want to bring down duration, then moving out of those kind of assets becomes a challenge for the fund manager. We have to sell those papers at a considerable loss, so which eventually, as a fund house, we have to pass on to the investors. So for flexibility point of view and over avoiding volatility, I think a 3-year makes more sense than going into a dynamic asset allocation. It makes sense in a falling rate interest rate scenario, but in a rising interest rate scenario, it takes time. And if redemption comes, the fund manager are usually very, very active in terms of selling the paper and taking some loss, which will eventually go to the investors. So these kind of funds make sense, but yes, I think from a liquidity perspective and for avoiding that volatility for most of the investors, because I'm assuming any layman wouldn't want volatility. They will not understand the intricacies of market where fund manager had to do a fire sale just to create liquidity. So with that, I think a 1 to 3 year category makes more sense because those papers are mainly more liquid and it's easier for the fund manager to exit as compared to a longer term fund.
Suppose that for some reason I've decided that I want to buy a short-term fund. Now, if I want to buy, let's say, a small cap fund, it becomes very easy for me to do. I go and search for small cap funds, Axis, LIC, ICICI, SBI, how they have performed, what stocks they have, and maybe I have some idea about it and then take a call on that. But when I look at, let's say, a short-term fund, whether I look at a short-term fund from Axis or ICICI or LIC or SBI, more or less all of them will be giving similar return. I don't think that I've ever seen more than a 2% gap in any, or even some 1% gap is sometimes rare. Never seen a 2% gap between two short-term funds. So how do I decide that whether I should buy SBI or LIC or ICICI? How do I come? Once I've decided that I want to buy a short-term fund.
I mean, it's a very valid point that how do you decide which fund to buy and all. But I mean, if you see in equity also, if you compare historical returns, any asset class, not only equity, any asset class, 10 years return or a 15-year return, you'll find the difference between most of them would be 1%, 1.5%. It won't be like one is giving 15%, another one giving 20%. There could be some outliers, that's okay, but most of them would be in the similar range category. So that also holds for debt. Of course, equity has a much wider time horizon to converge to that median range. Debt has a much smaller time horizon. But more or less in the long term, everyone makes similar kind of returns, because sometimes luck also plays a role where certain decisions you take, it doesn't go in your favor, and certain decisions you take unknowingly and it works for you. So that is one very difficult to predict. Now, what decides a good fund manager is what kind of direction or guidance that fund manager gives. Like, for example, 2 years back, we were giving this guidance that the GSEC was at 7.5. And we were saying that in next 2 years, take a 2-year call and it will come down to 650. And people agreed to that, but people also said that no, it's going to go to 8% and then come back to 6.5. But never happened. It went to 760 and turned back. So I think the way one can judge or one can assess a good fund manager is the kind of commentary or kind of guidance he gives. Like for any asset class, whether it's equity, debt, or any other asset class, the kind of guidance he gives with proper justification, with proper database as to why he or she feels what would happen and why it would happen. I think that is the kind of differentiation that one can understand. Of course, nowadays mutual funds are very transparent. They are giving out monthly commentaries. They are giving out their snippets on various social media platforms. So they are saying what they feel and what would happen. And once you start tracking that, as a layman, and see how it is reflecting in their performance, then you have your mind, because this guy talks what he wants to do and why he wants to do. So that gives you a direction that this guy talks sense. He's giving a guidance based on so and so data or number crunching down whatever he has done, and it is actually reflecting in the portfolio that he's doing. So that consistency will give you an understanding of who the good fund manager is and who may not be as good as no one else. I'm hopeful, just like you, the next 1 decade, I think probably you'll have more people coming in and understanding things. Of course, I mean, if you see a difference in last 5 years, I think a lot more people now are investing actively in debt, and they understand debt to an extent, which wasn't the case 10 years back, when no one understood what debt is. Today, at least, now people understand. So that kind of growth is there. But yes, still it is far from what we have achieved in equity. Hopefully, one day that also will be available on exchanges, and people would be aware of what is and how to go about doing it.
I think one of the best things that I don't really know whether Amphi did this or some fund house did, they stopped calling it debt. I think that has happened over the last 1 year or so. Let's say someone like you would probably be a debt fund manager and not a fixed income fund manager. How did this name change happen?
I think it was always there. I mean, I remember 2006-07 when I did my internship with one of the foreign banks, and I was in the fixed income department. So it was called fixed income. So I think it's mainly because of, as I said, it's more of a Western world term that has come, and now as we are now again getting merged with a lot of these Western counterparts, so this name is starting deriving from there, and suddenly now everyone calls them the fixed income fund manager instead of debt fund manager. It looks more quirky and and more aligned to the Western world and banks.
This part I did not know, that this is essentially not being driven. This is because India started happening on a global scale, and globally it is known as fixed income. That's why India is now adopting to these standards. Nice. Nice. Because I was under the impression that this is being done by, sort of a campaign like Mutual Fund Sahi was a campaign which got a lot of people who have no idea about mutual funds into mutual funds. Very similarly, this debt to fixed income rebranding is probably being done to attract those people who have no idea that it's sort of a fixed deposit counterpart product.
Projected as an asset class where you get some fixed income and regular terms.
Yes.
So this thing makes more sense to investors, and they start looking at it as the investment instrument where you get fixed regular interest.
But when the taxation rules changed, the real estate industry went back and shouted, no, we want 20% with indexation, and they got that for the real estate ones. You folks did really do that and ended up disappointing. You guys didn't lobby for this fact that we should also get that 20% with indexation?
We did a lot. Probably it's not come out in the open, but yes, we have done a lot. The AMFI committee was formally, approached the SEBI as well as the FM Trans Ministry also with this request. But yes, again, we can only make requests. That's what we've done, because we said that, with this kind of tax structure, with indexation going out now, it kind of puts us in a very disadvantaged position. Now, earlier we knew that if someone enters, they're going to stay there for 3 years. But now, now we are seeing that once the rate cycle ends, there could be outflow of money. So that is something which I think we are concerned, and we have highlighted our concerns. But again, I mean, it's the ministry's call and how they want to perceive it or what they want to do is.
I cannot go to the ministry. I'll go to you only, na? Ki boss, you
Yeah,
are
yes.
the ones who should take a word to the
I think,
ministry.
what, the banks also have a role to play in this, because, mutual funds, if you see, it's in direct competition with the bank FDs. So banks, of course, maybe have a role also here to play, because, once the indexation benefit comes in, FDs becomes less attractive. So probably they must have also lobbied hard to make sure that
I
indexation goes over.
understand doing it going forward. See, that's perfectly okay because you want to bring parity to any fixed income product. They should be tax similar. So going forward, fully agree. But for the past, at least, they could have continued this indexation bit like they did for the real estate ones.
The real estate lobby, I think that they are directly, contributing to the economy, and they have a much bigger say and voice in, what happens in the economy compared to mutual funds. Of course, they are getting bigger, but real estate has a direct impact on the end user, end consumer. So even not only real estate, but a lot of people who already own a lot of properties, they also had a say. So I think it was more so that their voice was much bigger.
Power in India is still fairly concentrated in real estate versus
Mutual
mutual funds.
funds,
Yes,
right?
mutual funds
Right.
have grown, but I don't know, but from an India perspective, are mutual funds at 10% of households? What would be the number at?
So mutual fund penetration, if you see, is around 3 to 4%.
3 to 4%. Nah, so
So
real
as
estate
compared
will be
to
20.
US, it would be around 27-28%. So the scope is huge. That's why now you see mutual funds. The one reason why AMFI has come with mutual funds here is because they want it to penetrate to the smaller towns, cities, and so people understand what mutual funds are. So once that happens, I think this market has a lot of potential to grow. I mean, today we are at around 40 lakh crore. It could go to easily, 10 times or 20 times in the next 10 years if people start understanding. Although last 4 years has been seen a good growth, but I think it has a lot of potential. The penetration is really low.
I certainly hope that happens because if the market grows, my portfolio grows and your portfolio grows as well. And on that note, I'd like to thank Rahul. Thanks a lot for taking
Thank
out
you very
time and
much. It was a
explaining all
pleasure.
these details about debt mutual funds, fixed income mutual funds, as I should say. So thanks for
Thank you.
coming to
It was a pleasure having you. Thank you. Thank you.
thanks for coming to the show, and to everyone watching. Please do like this video. We have had couple of folks from the equity side in our last few episodes. Coming in the next episode, we'll have another person from the debt industry. I hope you guys are liking this series. If you are, please let me know via the comment section. This is Ravi Handa signing off. Thank you.